So let me share my screen on my iPad. Okay, let's have a look into today's topic on monetary policy. Okay, so for monetary policy topics, right, it will be divided into part 1 and part 2. For the part 1, is more towards the understanding of the concepts, like to understand the relationship between the interest rate and the quantity demand of money, okay, to understand what is money supply and what is money demand. And then next week tutorial, when it comes to the part 2, is more on the policy itself, like what the central bank can do using the monetary policy to control the economy. So today's one is more on concepts, and then the next week one is more towards the policy making itself. All right. Now, as usual, first of all, we'll just go through a quick recap for you to revise back those important terms. So to understand monetary policy, the first one that you need to know is to understand the meaning of money itself, to understand the functions of money. So how do we define money? We say money are basically the assets that people are willing to accept in exchange for goods and services. So it's an asset that you can use it for the purchase of goods and services for any of the transactions because it's just generally acceptable. Okay, so with money, right, it can solve the barter trade. Because previously, without money, we have to use barter trade, in which, like, for example, if I want to buy something from you, I need to exchange something with something that you really want. Like, for example, you are selling apples, okay? I have orange, so I have to exchange my orange with your apples, provided if you want my orange. So you see, that requires double coincidence of ones for the barter trade. But with the use of money, we don't have to worry about this anymore. It solves the barter trade. Okay, so therefore, when we give money to people for any transactions, we are able to proceed with transactions. Okay, so what are the 4 functions of money? So we have 4 functions of money over here. The first one is a medium of exchange. A medium of exchange means that we can use it for the purpose of making transactions, making purchases. Okay, it's a means of payment. Okay, that means that it's something that people will accept. Okay, generally will accept in exchange for goods and services. Second is a store of value. A store of value means that like money, right, is a form of liquid assets. It can be stored, it can be held. Okay, after a certain period of time, you can use it later on. So that means like it can play as a means of saving. So it's a liquid asset. You can keep it for now and then you can use it in the future, or you can save money in different form of asset as well. Like, for example, today you do not want to save money in banks. Okay, you do not want to hold it as a liquid asset. What you can do is maybe you can invest in stock, invest in bonds, invest in properties. So money can be stored in the different form of assets and it can retain its value itself. The next one is a unit of account. That means we are saying that we can use money to actually state the prices of goods and services. So easier for us to do comparison between the prices of products, easier for us to evaluate the prices of the products. And the last function is a standard of deferred payment. Okay, means that we believe in the value of money. So therefore, what happens is it can facilitate exchange over time. That means, like, for example, today I can buy the goods and services on credit first, then afterwards I can pay on installments. Because very often in real life, not all the payments made immediately. You know, like, for example, when you buy cars or you buy houses, you pay by installments. So therefore, because we believe in the value of money, we don't have to worry that, oh, one day we will not use money anymore. So this is why the money can be used as a function of a standard of deferred payment. That means we buy the goods now and pay installment in the future. Okay, so therefore these are the 4 functions of money itself. Now, some concepts over here. What are the types of demand for money? That means that reasons. Okay, the reasons. So you can think about this as the reasons. Okay, the reasons for the demand for money. Like, why do we need money? Okay, why do we need money? What are the reasons? So first one, we use money for transactional purposes. We call it as transactional related reason. okay, for transactional purposes. So we need money on a regular basis to pay for the bills, to pay for the goods and services, to pay for transactions, to pay for our consumption. So that's for transactionary purposes. The second one is that money can be used as a precautionary purposes. That means we need money, we need cash for emergency purposes. Okay. The third one is we need money for speculative reason. Okay, means what? Means like, for example, if we expect the value of the money to increase, okay, versus other asset class. So therefore, what happened is I want to keep more money on hand. Okay, if let's say I feel that money is losing its value and it would be better for me to store in other form of assets like bonds, then I want to exchange my money to bonds. So therefore, we have this term called asset demand for money. Asset demand for money means that I withdraw the cash, okay, from my banks in order for me to buy certain assets, certain investments like bonds, like stocks, like shares. But for our topic, we are going to look into bonds specifically. Okay, so that means that we as individuals, right, we can switch between, like, for example, whether I want to keep money as cash on my hand or whether I want to exchange it to buy bonds, to buy assets like bonds. Okay, so therefore here, when we talk about the speculative flow of money, speculative reason over here, we refer to the asset demand for money. Okay, so asset demand for money means that I cash out, I withdraw my cash, okay, for the purchase of asset like bonds. So asset demand for money means what? Means that you withdrawal of cash to purchase assets like bonds. Okay. So remember, asset demand for money means that we are cashing out, okay, to purchase assets like existing bonds. Okay, now when we talk about bonds, right? Okay, let's understand bonds again in case if you have forgotten from your intro to finance. Okay, so how bonds work? Okay, so remember when we talk about bonds, right, in our topic itself, in this tutorial, we are referring to existing bonds or old bonds. Okay, so later we want to differentiate whether we are referring to old bonds or new bonds. But first, let's understand how bonds work. So for example, you have a Mr. A over here. Okay, Mr. A would like to buy a bond. Okay, so how the bond works will be like this. This is year 0. Okay, so what happened is if he would like to buy the bond, the face value of the bond itself is 1,000. So that means he need to spend 1,000 first currently. Okay, now assuming that let's say this bond itself, it give a coupon rate. Let's say it give a coupon rate of, let's say, 10%. Okay, so that means every year, let's say if this is an annual bond, so and every year, how much will he be receiving? So how much is the annual coupon? So the coupon payment, okay, is 10% of 1,000 is how much? 100, right? 100. Okay, so that means that every year, he will receive this 100 until it matures. Let's say it matures at year 6, for example. So every year he will be receiving this 100, 100, 100, yada yada yada, until it matures in year 6. He will receive the same 100 plus the initial face value of 1,000. Okay, so how is he making money from the purchase of bonds? So from all these 100 annual payments that he received, the annual coupons that he is receiving. So that's how he makes payment from the bonds itself. Okay, so like let's say for example, in between he wanted to sell it to someone. Yes, he can sell it to someone, like for example Mr. B. Okay, let's say if he wants to sell to someone, he can sell to Mr. B over here. Okay, If not, he can hold it until it matures. Now, one thing I want to remember is this. There is an inverse relationship, okay? There is an inverse relationship between the price of bonds and interest rate. What do you mean by this? Inverse relationship between price of bonds and interest rate. Okay, first of all, a few things I want you to remember. Okay, inverse relationship, one up, one down, okay, between the price of bonds and interest rate. Okay, interest rate over here, we are referring to the market interest rate. What do we mean by market interest rate? So we call it as a nominal interest rate, okay? Remember, when a bond is being issued, right, they will give an interest rate. Like, for example, just now, like, for example, here you can see a 10% over here, right? Okay, so whenever new bond is being issued, they will promise a certain interest rate they will pay to the investors every year or every half a year. So what happens is whenever a new bond is issued, it is following the current interest rate in the market. Okay, now when I say price of bonds over here, we are referring to old bonds. We are referring to old bonds. Old bonds means what? Existing bonds. Okay, so for example, let's say the market interest rate is higher. Okay, let's say the market interest rate now is higher. So that means that when new bond is being issued, right, it will follow the new interest rate. So that means that if you buy the new bond, it is more attractive because they give you a higher annual payments, annual coupon payment as compared to the old one. So therefore, everyone will buy the new bonds, right? So when the interest rate in the market is higher, everyone will prefer the new bonds over the old bonds. So what happened is the demand for old bonds will fall because not worthwhile anymore because the new bonds will give you better interest rate. So when I say old bonds means existing bonds, okay? So therefore, the price of existing bonds will fall. Okay, understand this? So do you realize one thing here? When interest rate becomes higher, the price of existing bonds will become lower. Vice versa, when interest rate becomes lower, okay, means what? The new bonds that's being issued will follow a lower interest rate that is not so attractive. So people will prefer the old bonds. So the demand for the old bonds, or what we call as the existing bonds, will becomes higher, and therefore the price of the existing bonds will become higher. So here you can see one thing here. When interest rate goes down, the price of existing bonds will go up. So there is an inverse relationship that you can see over here. This relationship is important because you have to put it as part of your analysis later on. Okay, so this is why one thing we can see over here is that when the interest rate becomes higher, the asset demand for money will go down. Okay, because I do not want to cash out so much of money to buy existing bonds anymore. Okay, same thing. Remember, every time we talk about bonds here, we are referring to the old bonds actually. Same thing if I say interest rate going down, when interest rate becomes lower, so what happened is it is more worthwhile for you to buy old bonds or existing bonds. So people will have the tendency to cash out their money to buy all these old bonds. So therefore, the asset demand for money, okay, that means the purchase, the withdrawal of cash for you to purchase all these bonds will go up. So therefore, you can see here, this one is like asset demand for money. Okay, asset demand for money. So remember, from a layman term, that means that you withdraw cash for the purchase of assets, like bonds. Okay. So remember this relationship first. We'll come to question like this later on as well. Okay, now moving on to look into the graph for money market. Okay. So let's have a look into the graph itself. Okay. So first of all, let's look into the money market diagram. So first of all, on the y-axis here is interest rate. Okay, this is interest rate. On the x-axis over here is the quantity of money or quantity of real money. Okay, and this is my money demand curve. It's a downward sloping curve. Why is that downward sloping? Because there is an inverse relationship between interest rate and the quantity of the real money. Okay, means what? Means, for example, when interest rate goes up, okay, when interest rate goes up, means what? Means it's actually more worthwhile for you to save money in banks actually. Okay, and the cost of borrowing is very high. No point to actually go and borrow more money. Okay, so might as well I want to put the money in the banks. So therefore, the quantity of the real money demanded, okay, will fall, vice versa. Okay, so this is why you can see that when you look into this diagram, over here, at first you are at, let's say, this point A, at this interest rate, at this quantity of money, but when interest rate goes up, okay, what happened is the quantity demand of money will fall. Inverse relationship over here. Okay, same thing if it goes down. If it goes down to, let's say, point C, okay, means what? Means interest rate becomes lower. When interest rate becomes lower, what happens is quantity of the real money demanded will increase, because when interest rate becomes low, that means cost of borrowing becomes lower. So people will actually borrow more money. People will not want to save money in banks. So therefore, the quantity of money demanded will increase. Okay. So I have put some explanations over here. As you can see, okay, you can see that when we talk about higher interest rate, there will be lower quantity of money demanded. Why? Because you get higher returns from saving. You might as well save money in banks. So when interest rate is high, okay, now let's say I want to relate this to the bonds concept just now. When interest rate is high right now, okay, what happened is the opportunity cost of holding money in asset like existing bonds will be very high. Means what? Means that you see today, if the interest rate is high, means that it's actually more worthwhile for me to buy new bonds. If I'm still keeping old bonds, the opportunity cost is very high. Means what? I will lose a lot of things. There will be a lot of things that I will be forgone because I don't able to get the high interest rate if I buy a new bond. So when interest rate is high, okay, it will be better for me to buy new bonds as compared to old bonds. So that's why we say the opportunity cost, okay, the opportunity cost of holding money in old bonds will be very high. Not good. This is not good. Opportunity cost high is not good. You miss out a lot of things. You miss out the potential returns that you could have earned by investing in new bonds. So this is why when interest rate is high here, if I want to relate to the bonds concept, okay, the demand for old bonds will fall. Okay, that means that we all go and buy the new bonds. Okay, vice versa, if the interest rate is low, okay, means what? Means that there will be higher quantity of money demanded. Why? Due to the cheap borrowings. Remember, interest rate is always the cost of borrowing. So same thing here, if I were to relate to the bonds concept here, when interest rate is lower means what? It's more worthwhile for me to buy the old bonds. So therefore, the opportunity cost of holding old bonds or existing bonds will become smaller. It falls. Means what? Means yes, it's more worthwhile for you to hold old bonds. Okay, because if you buy a new bonds, it gives you lower interest rate. So therefore, when interest rate is lower, I will prefer old bonds. People will prefer old bonds, so the demand for old bonds will rise. Okay. So from here, you can see the relationship between the interest rate and the quantity demand for money. Okay, so actually, you can relate this to asset demand for money as well. You see, when your interest rate is high just now, I say already, you will prefer to buy new bonds, not old bonds, right? So the demand for old bonds will fall. Means what? Means asset demand for money will fall. Okay, same thing when I say interest rate becomes lower, means that you will prefer old bonds. So people will want to cash out money to buy old bonds. So asset demand for money here will go up. Okay, people will withdraw money to buy assets like bonds. Okay, so this is for us to explain the movement along the money demand curve. So remember, when you look into movement along, what causes the change in the quantity demanded for money is mainly the interest rate itself. Only the interest rate that makes the changes in terms of the quantity of money demanded. Okay, only this interest rate that make changes in the quantity demand of money. Now, on the right-hand side, we have non-interest rate determinants. Non-interest rate means that it's not due to the interest rate itself. Same thing, y-axis is your interest rate. X-axis is your quantity of real money demanded or quantity demand of money. Okay. So what happens is your money demand can increase or decrease over here. Either it shifts leftwards or rightwards, but due to other factors. You can see that interest rate remain the same. Interest rate remain the same. Okay, but maybe more money demanded or less money demanded. So interest rate do not change. Your interest rate is fixed here, but the money demand either increase or decrease. So what are the factors that could result in the shift of money demand curve? We have three here. The first one is real GDP. Okay, like for example, when there's an increase in real GDP, means what? Means that country is doing good, there's economic growth, so the volume of expenditures will increase, and that will increase the transactional demand for money. Okay, so therefore, with the same interest rate, people will want to hold more money, okay, because they want to buy more goods and services. Okay, same thing when you look into price level. A rise in price level, let's say due to inflation, okay, will cause a fall in the real value of money. Like for example, a 10% increase in price, okay, will increase the quantity demanded of money by 10%. Why? Because you need to buy the goods and services. So therefore, higher price level will also increase the transactional demand for money, okay, at the same interest rate. Okay, today people will need to have more money on their hand because they want to buy goods and services because now it becomes more expensive. Okay, so nothing to do with interest rate. The third one is financial innovations. Like for example, here we talk about the use of credit cards, debit cards, internet bankings, and e-wallets. So like for example, today, if all these things are highly available, so what happens is it will reduce our money demand because we don't have to hold so much money on our hand anymore. Okay, so because of the ease of transferring money, it reduced the money demand. So you can see over here, the money demand increase or decrease has nothing to do with the interest rate, but because of the other factors. Okay, so these are the things that you need to know for your monetary policy contents. And now we are going to look into the tutorial questions. Okay, let's have a look into tutorial questions. So overall, quick summary here. Now you can see that interest rate and the quantity demand of money are inversely related. Interest rate and the price of all bonds are inversely related. That one you can see from this one that you see just now. Okay, you can see is inverse, one up, one down. one down, one up. Okay. And the interest rate and the demand for old bonds are also inversely related. Same thing from this one as well. You can see that interest rate and the demand for old bonds, interest rate and the demand for old bonds are inversely related. Okay. Now let's have a look into the third question. So which of the following factors will lead to either a shift of money demand or movement along? So first one, increase in consumer confidence level. Okay, increase in consumer confidence level. Okay, so people become more confident towards the economy. So what happens is they will spend more. They will spend more. So therefore, higher transactional demand for money. Transactional demand for money increases. So therefore, that will shift the money demand curve rightwards. Okay. So if I want to draw a diagram, very simple. So this is my interest rate. This is my quantity of real money. Okay. Now, when it comes to the next chapter, you will learn about money supply. For now, I just let you know that money supply is fixed like this. Money supply is a vertical straight line. Okay. And only central bank can adjust money supply. They can increase or decrease money supply by using monetary policy, by using the tools that we are going to learn in next week. But for now, I just want to remember money supply is fixed, a vertical straight line. Okay, so that's the money supply. Okay, and put it so money demand is downward sloping like this. At first, you are at here, point A. Okay, at this interest rate, at this quantity demand of money. So money demand increases. Shift rightwards. Okay, so you can see here, after it moved to here, point B over here, there is a shortage that push the interest rate to point C. Okay, so therefore you can see that at the end, it will result in higher interest rate. But for this one, they just ask you whether it will shift or movement along. So you just need to say that it will shift the money curve outwards, or what we call as rightwards. Okay, so you can see here, interest rate becomes higher. So you will prefer new bonds over the old bonds. So the demand for old bonds will fall. Okay. Okay, next question. A decrease in interest rate. Now, decrease in interest rate factor. Okay, so this is interest rate factor. So we are referring to the movement. Okay, remember we just say lower interest rate result in higher quantity of money demanded. Or you can say quantity demanded of money. Okay, so it's a interest rate factor. So no shift, only movement along. Okay, so therefore for this one is only movement along. Okay, because here is about the interest rate factor. So when interest rate becomes lower, cost of borrowing becomes lower. So therefore people will want to hold more money. People want to borrow more money. Okay, so the quantity demand of money will increase. Same thing as well. If you want to relate to the concept of bonds, what happens is when interest rate becomes lower, means that it's actually more worthwhile for you to hold old bonds. So the demand for old bonds will go up. So you will want to cash out money to buy old bonds. So the asset demand for money will go up, as you can see from this relationship itself. Okay. So just remember, when interest rate becomes lower means lower cost of borrowing. Okay, so that means that people just want to borrow money and spend and consume. Okay, so you can see that we say lower opportunity cost of holding cash. So that means that more worthwhile for you to hold cash on hand. Okay. Okay, next one, expansionary fiscal policy by government. So expansionary fiscal policy. So when we talk about fiscal policy, we have expansionary fiscal policy, we have higher government spending and lower taxation. Okay, higher government spending and lower taxation. Okay, so therefore, what happened here is when we talk about this expansionary fiscal policy here, we have higher government spending and lower tax. It will actually help to stimulate the economy. Okay, so therefore, the real GDP might increase, people might spend more, the volume of expenditure may go up, so that will increase the money demand. So the explanation here is the same thing like just now. When the economic activity is being stimulated, it will increase the volume of expenditure. Okay, it will increase the transactional demand for money. Okay, so at the end, it will result in the shift of money demand curve, just like just now. Okay, next one, expectations of future inflation. People expect that there could be future inflation. So how? So for this one, if you feel that there could be a high inflation in the future, you may not want to hold so much of cash on your hand. Okay, you want to change to assets that can retain the value of your real wealth. You want to retain your real wealth. So therefore here, it will influence the money demand. Okay, because people may choose to hold less cash if they anticipate rising prices, leading to inward shift of the money demand curve. Means what? Means you want to hold other assets. Okay, you wanted to hold other assets to retain real wealth. Okay, you do not want to hold so much of cash, so money demand curve will shift leftwards. Okay, money demand curve will shift leftwards. Next one, a decrease in the availability of credit cards. Okay, so decrease in the availability of credit cards means that there is less, okay, that there is less financial innovations. So what happens is you will need to hold more money. So therefore a decrease in the availability of credit cards can influence money demand, okay, because it limits the alternative forms of payment. So therefore it will shift the money demand curve rightwards. Okay, because a decrease in the availability of credit cards means it reduces alternative forms of payment. So you no choice but to use cash, so money demand will increase. Okay, let's move on to the next question. Would the following scenarios lead to an increase in the asset demand for money? Okay, so whether it will lead to an increase in the asset demand for money or not. So let's look into each scenario. The first one, the central bank decrease interest rate to stimulate economic growth. Okay, so okay, this one, next week you will learn more in details, but now we just look into the relationship that we just learned just now, the relationship between interest rate and the demand for bonds. Okay, so central bank decrease interest rate, whether it will increase the asset demand for money or not. Okay, let's just focus on these two, the relationship between these two. Okay, so what happened is decrease interest rate. Okay, so okay, let's just look into our explanations because here they talk about new bonds. Okay, so remember one thing, when interest rate goes down, means what? Means that it is actually more worthwhile for you to hold old bonds. Okay, because interest rate goes down means that if you buy a new bond, the new bond will follow the new interest rate that's lower. Okay, so therefore here, okay, the demand for old bonds will go up. So if I look into old bonds, actually the answer is correct. Means what? Asset demand for money will go up. By right, usually we look into old bonds one. But here you see the reason why you see that it's a false here is because she looks into new bonds. Okay, so that means what? That means when interest goes down, the demand for new bonds, okay, goes down. Depends on which one you want to look into. It's the same thing. It's just that I use different perspective. One from old bonds, the other one from new bonds. So the asset demand for money goes down. Okay, so this is why he says that here a decrease in interest rate, it will lead to a decrease in the new asset demand for money. That means a decrease in the asset demand for money, because she looked into new bonds. By right, to be exact, we look into old bonds. Right? So if you look into old bonds, that means correct, it will lead to an increase in the asset demand for money. So in exam, you're scared that you make mistakes, right? You specify whether you are referring to old bonds or new bonds. Okay, but usually we refer to the old bonds. Okay. Yeah, like here you see that the lower of the new interest rate would increase the demand for old bonds. This one's correct. So you must follow the old bonds. Right? Usually we follow old bonds. Right? So in exam, if you worry that you make mistakes, you specify whether you are referring to old bonds or new bonds. Okay. Not sure. Must specify lah. Specify old bonds or new bonds. Not sure as in what? Not sure the relationship. Then is a problem already. Then I will assume you write old bonds. If you just write bonds, I will assume it's old bonds. Usually we refer to old bonds one. By default, okay, it's old bonds. Unless you specify otherwise. Okay, now next question. So you see here, then this one she also drew correctly. Only this one that she actually should put it as true because we are referring old bonds. You see here, okay, like for example, this graph over here, you can see that money supply shift rightwards. Okay, money supply shift rightward because here we said that central bank want to reduce the interest rate, right? So one way is to increase the money supply. Now this one you will learn next week, okay? This one you will learn next week, but I want to explain to you first. Okay, so you see, central bank want to reduce the interest rate, so they have to increase the money supply. Increase money supply means shift the money supply curve rightwards. So you can see at first, okay, is at point A here. Then after that, it moves to point C here. Okay, so interest rate goes down. Okay, so this is what I say. When interest rate goes down, okay, the demand for old bonds will increase. I can show this on demand supply curve. So this is the demand supply curve for the bonds, okay? So the market for old bonds. Remember, you see, we always refer to old bonds one. This one is for old bonds, okay? So on the left over here is the monetary policy that you are going to learn next week, this monetary policy. Okay, on the right hand side is the market for old bonds. So what happened here is the demand for old bonds increases. So therefore you can see the demand curve shift rightwards, and therefore from point A to point C over here. Okay, ignore this point B because it's not so correct, because when you move to here, point B should be here actually. They only move to point C. Okay, ignore the point B. Okay, so you can see this is why we say that when the demand for old bonds increase, what happened to the price of old bonds? It will increase, increase. How do I know? You can see from here. Price of old bonds increase. Okay, so this graph here show me the demand of old bonds increases and the price of old bonds also increase when the interest rate fall. Okay. Okay, next one. Consumer confidence level plummet. That means goes down. Okay. Due to economic uncertainty, causing households to reduce their spending. So they actually so what happened here is that because of economic uncertainty, consumers spend less. Okay. So what will happen to the asset demand for money? For this question, answers is a bit generic lah, but let's just follow her answers. So she said that false because investors will shift their asset, okay, from riskier assets, okay, such as stock or bonds, towards safer assets like fixed deposits or gold. So that means that here we do not comment about whether people will buy bonds or not. We just say that they shift their focus from the purchase of stock or bonds towards FD, towards commodities like gold. So therefore, we say false as in that today, when consumers spend less because of economic uncertainty, there will be no impact toward the asset demand for money itself, because people will just buy, will just put money in FD, will just buy gold. We don't talk about bonds at all. So that's the answer. So we just follow our answers. If not, right, if you want to relate to bonds, right, it will be represented by a leftward shift of money demand curve for this one, because consumers spend less. So that means less transactional demand for money. So money demand curve will shift leftwards if you want to follow what we learned. But her answers over here is trying to say that because of economic uncertainty, we just don't want to buy bonds, because bond itself is also risky. Although it's considered as quite safe already for bonds, but it's still, there are risks. So therefore, more rational choice will be they will just put their money in FD. Okay, so that's her answers over here. Okay, because these assets are perceived as less volatile and provide a hedge against the uncertainty itself. So therefore, the demand for fixed deposits for gold will be higher. So that means we don't talk about bonds over here. Okay. Now, question 3. Explain the impact on the money market equilibrium using the money market diagram. Okay, due to the following scenario or incident. Also include explanation. How will this impact asset demand for money? Okay. Okay, so we need to relate to asset demand for money. Okay, first question, increase in the country's inflation rate. Very easy, this one. Remember, we just say increase in inflation rate. Okay, now inflation rate happens, so price level becomes more expensive, right? So therefore, here we say that inflation reduce your purchasing power, erodes your purchasing power. So it lead to a decrease in the real value of money. So you need to demand more money to buy goods and services. Okay, you need to have more transactional demand for money because inflation rate happens, price level becomes higher. You need more money, more transactional demand for money. So therefore, this will shift the money demand curve rightwards. Okay, so I can show this on the diagram. This is my interest rate. This is my quantity of real money. Make sure you label. This one doesn't label one. Okay, this one is money demand, and then it shift rightwards. MD1. Okay, so from here initially point A, it moved to here point B. Okay, so quantity is here. Interest rate has gone up. Now remember the question asked us to comment about asset demand for money. So can someone tell me, now we end up at a high interest rate. What happened to the asset demand for money? Higher or lower? Interest rate goes up, asset demand for money will go down. Okay, why? Because the demand for old bonds will fall. Because people prefer to buy new bonds. So if we look into old bonds, the old bonds demand will fall, means what? Asset demand for money will fall. Because you will prefer to buy new bonds, not the old bonds anymore. Okay, can move on. Okay, increase in the usage of debit cards. Increase in the usage of debit cards. You see, you can try to write some notes over here. Usage of debit cards means what? More financial innovation. Okay, more financial innovation. So they are more alternative forms of payment. I look for all these keywords when you explain all this in your exam. Exam type question. Okay, so what happened is you do not need to hold so much of money, right? So money demand will go down, will shift leftwards. Okay, so you can see the explanation over here. It provides convenient alternative way to cash transactions. So reduce the money demand. Okay, so it reduced the money demand. So it shift the money demand curve leftwards. So same thing I can show on this diagram. Interest rate, quantity of money. So this one she draw. Oh, something is wrong. This is 1. This is 2. Hey, this one got problem already. Okay, let's redraw it. Let's redraw it. Okay. The labeling, I think the labeling got problem. So let's just draw again. Oh, I don't know why it's like that. Something is not right. Okay, can again. Okay, so y-axis, x-axis, origin. This is your interest rate. This is your quantity of money or quantity of real money. Okay. You have your money supply curve. Okay, and you have your money demand curve. at first is here at point A, at this interest rate, at this quantity of money. So now there is what? There's an increase in the debit cards. So I don't have to hold, people do not have to have so much of money demand. So it shifts the money demand curve leftwards. Make sure you label everything. From point A to point B over here, there's a surplus. So therefore, it will move to the new equilibrium at point C that result in lower interest rate. So this is your final outcome. Okay. So it means what? So here we can see that interest rate goes down. So can someone tell me the asset demand for money? Goes up, correct. Yeah, why? Because the demand for old bond, you see, in exam, if you scare, you write wrongly, you just say the old bonds. Demand for old bonds will go up. Okay, so means what? So the asset demand for money increases. Means that you cash out money to purchase assets like old bonds because it's more worthwhile for you to hold old bonds already. Why? Because the new bonds will give you low interest rate. Make sure you label everything. Okay, moving on. So because all this labeling are not so correct, so that's why I redraw the diagram. Okay, next one. Real GDP increased by 15%. See, easy question. You try to write the keywords. Real GDP increase means what? Increase in the volume of expenditure. Increase in the transactional demand for money. Therefore, money demand will shift rightwards. Okay, so same thing, we draw the diagram. Interest rate, quantity of money, money demand curve, and money demand curve shift rightwards. Okay, from initial here, point A, at this interest rate, it moves rightwards. There's a shortage that push up the interest rate to here. So I can just put it as point P lah. If you want, you can draw it like this as well. Point B is here, and then point C here also can. Or I straight away go directly to the final equilibrium also can. Okay, I straight go direct there. So it result in higher interest rate. Interest rate higher, what happens to asset demand for money? Lower, because the demand for old bonds go down. People prefer to buy new bonds. Okay, so the demand for new bond rises, but the demand for old bonds fall. So asset demand for money, if we're referring to old bonds, that means it will be going down. Okay, so now you can understand asset demand for money, right? At first, it used to be very challenging to understand. Now you understand already, because asset demand for money means what? We are referring to the withdrawal of cash for you to purchase assets like bonds. And usually we refer to old bonds, existing bonds by default. Okay, so these are the things that you need to know for the monetary policy part 1. So in next week lesson, we are going to look into part 2, in which we are looking into how central bank or how government could influence the agro demand in the economy, could influence the economy with the use of the instruments of the monetary policy itself. That's why we will start to see how central bank, what central bank can do and how they can do to adjust the economy, right, to control the agro demand. Okay, so these are the things that you need to know for today's tutorial.